What is Nvidia stock really worth? We can see it has shot up 239% year to date, and companies similar in the industry like Broadcom, Avgo, they have shot up to all-time highs and continue to push further. So is Nvidia Corp a solid company to add to your portfolio, and what is the real value of this company? Today's episode, we are going to take a detailed look at Nvidia, looking at their income, their top line revenue, as well as their bottom line net income growth. We want to look at the safety of the company in terms of their balance sheet, their total cash versus total debt, and we do want to compare them to how they have performed over the last 5 years on a total return basis versus some of their well-known competitors, including Taiwan Semiconductor and Broadcom. We're also going to take a quick peek at what the institutions are doing with this company, as well as looking at not only that dividend safety, but some very important financial metrics that you need to understand about this company. And as always, we will run them through our stock valuation model, getting to our intrinsic value and finding the acceptable buy price of Nvidia. And believe me, the results will surprise you. Now, as we mentioned, year to date, they are up 238%. They do offer a yield, although it is very, very small. And we can see they are right there at their 52-week high. Now, in terms of the last 10 years, well, if you had invested, you would be up 12,319%. No, this is not cryptocurrency. This is the stock market. Now, what we're going to do is take a look and see whether or not there is some real value in Nvidia, even at these 52-week high prices. So their top line revenue, 11.7 billion reported in Jan 2019. Latest annual report, 27 billion. So they have more than doubled their top line over the last 5 years. And on top of that, we can see year on year, slight decrease in 2020 before picking up around 60%, and then a strong increase to 2022 before remaining relatively flat in 2023. And we can see the trailing 12 months are looking like it will be very high for January 2024's annual report. Now, in terms of the bottom line net income, what story does that tell us? Well, 4.1 billion bottom line January 2019. January 2023, 4.4 billion. So the bottom line has increased very slightly in compared to the massive increase we saw on the top line revenue. And again, we can see the decrease in January 2020 before an increase to 2022 before decreasing. So interesting to see that whilst we do see some increases on the top line and bottom line over the last 5 years, we do see some real inconsistencies on that year-on-year growth. Now, in terms of the safety of the company, the balance sheet, the total cash versus total debt, well, they held around 7.4 billion of cash and short-term investments in 2019. Latest quarterly report, they hold double, around 16 billion, in fact, slightly more than double. And when we compare that numerically and directionally to the total debt, 2 billion in 2019, and this has gone up by nearly 6 times to 11 billion in their latest quarterly report. So yes, they do hold a lot of cash, as we did see, around 16 billion, which would be able to pay off all of that debt if needed. Now, comparing it to some of their competitors, we see Taiwan Semiconductor, Broadcom, and a few others. So year to date, it should come as no real surprise that Nvidia has absolutely wiped out their competitors. And now, yes, this does include those dividends reinvested, but you are talking a very, very small percentage. When we expand that to the last 5 years, which is always good to do when you have that data available, what we can in fact see, again, Nvidia has wiped out all of their competitors, but you could argue this has only been through the last year, and that is where they really managed to increase higher than the other competitors. But if you look, if you have backed the right semiconductor company over the last 5 years, you would be laughing. Avgo up 406%, AMD up 557%, but if you did pick the ones that maybe weren't as favorable, such as Intel, you probably wouldn't be laughing. So remember, as always, past performance is never indicative of the future, but it is one step that we do as part of our analysis. So Nvidia, 65% institutional ownership, 38 billion sales over the last 12 months by institutions, but a whopping 633 billion of institutional inflows. And we can see depicted here by the green bar, 599 billion of that in Q2 of 2023. So the institutions have a large conviction in Nvidia. Remember though, please do not copy what institutions do. You do need to do your own due diligence. So before we look at the financial metrics and dividend safety, let's take a very quick look at their latest earnings. So what we can see, whilst they had expected 16.11 billion on that top line, they in fact reported 18.12 billion, a positive surprise of 12.5%. Likewise, 339 expected on that earnings per share, 4.02, a nice 19% positive surprise, which is very strong to see. If we look at the last quarter, again, they beat both on the essential earnings per share and top line. And we go to April, again, some very nice increases. And we can see, in fact, over the last 4 quarters, they have beaten Wall Street estimates on both the revenue as well as that earnings per share. Now, very quickly, dividend safety, although the majority of investors who do invest in Nvidia probably do not really care about that very, very minuscule yield. But nonetheless, 89, the market cap sitting at 1.23 trillion. It is a mega cap company. Now, in terms of some key metrics, they didn't pay a dividend in 0709, so we have no comparative data. Now, they had negative 35% sales in the last recession, which was below the average growth of companies in the S&P 500, which was negative, however, to a smaller degree. And we can see they far out underperformed the S&P 500 with a negative 78% return versus the S&P's negative 55, something just to digest for those investors who see a recession inbound. Now, they haven't increased that dividend since 2008, so over the last 5 years, that dividend compounded annually at a rate of 2%, and the last 10 years, yes, it is very nice at 24%, but let's be honest, investors for Nvidia would be more focused on that capital appreciation. Now, when we take a look at dividend yield theory, just to keep it consistent, although it's not as relevant for this company, it is sitting the yield below the 5-year average of 0.03. Typically, this is a sign of overvaluation as it is below the 5-year average. And then the forward PE telling a slightly different story, a sign of undervaluation as that forward PE sitting at 25.4 below the 5-year average of 41. Now, we will shortly look at the valuation as well to get our estimates. Now, just to keep it simple, the sector PE 22.3, Nvidia slightly higher at 25.7, and we can see bang on right there at the 52-week high, making this probably the only stock on the channel we have reviewed at a 52-week high. So now is the perfect time just to let you know that a 52-week high does not signal overvaluation. Likewise, when we look at stocks at their 52-week low, this also doesn't signal undervaluation. Now, very briefly, because it is a very small essential yield, free cash flow always over earnings. Earnings is susceptible to manipulation by management through accounting. Below 60% is what we look for, so management can offer those double-digit increases. But bear in mind, given the yield is so small, it comes as no surprise that we see around 10% for that payout in 2023, with 2024 expected to be around 1 to 2%. So that comes as no surprise. Now, free cash flow payout, 25 cents in 2014. 153 in fact in 2023, so it has increased over the last 10 years, but for a company like Nvidia, you may have expected a much larger increase on that free cash flow per share, especially given that share price appreciation over the period. Now, when we compare this to the sales growth, and we do like to see 3 to 7%, what we see with Nvidia for the large part of the last 10 years, yes, they had some negative growth, but on the large, we do see double-digit growth every single year, which is very, very positive for any investment in your portfolio. And numerically, it translates to around 4 billion of sales in 2014, and we see around 27 billion in 2023. So that is very positive. In my opinion, you're looking at a 7 times growth over the last 10 years on that sales. And shares outstanding, slight inconsistencies. We do see some share buybacks over some years, and then we do see some share issuances diluting your position. Over the last 10 years, 2.38 billion to 2.51. Not the greatest for investors, but let's be honest, you wouldn't really care if you were having that share price appreciation. ROIC, remember 10% or more, it does mean that management are able to effectively allocate their capital. For the large part, it is above that 10%, with 2023 at 16%. Margins for semiconductors, 16% for the operating margin, which we do see very positive. And then when we look at that free cash flow margin, 5% or more for the free cash flow. Again, very positive on both margins. So that is positive to see as an investor. Net debt to EBITDA, we did essentially mention this. This effectively shows the number of years it would take the company to pay off all of their debt net of cash on hand. Wouldn't even take them one day. No real surprise there, as they do have more than enough cash to pay off all of their debt, as we saw in our analysis. So let's jump to the stock valuation model. Now, as always, if you do enjoy the content, value is being provided, do hit that like button, do subscribe and hit the bell so you are continually notified of these videos as they drop. And if you do want to grab a copy of the valuation model we're about to run through to calculate the intrinsic value of companies in your own portfolio and your acceptable buy price, then do click on that pinned comment below. Now, typically with Graham's valuation, we don't use these on REITs. We also don't use these on companies where they do have significant growth year on year, as it does make it irrelevant. So we will be excluding this from our valuation purely based on the fact that we did see Nvidia does have double-digit growth nearly every single year, and this is expected to continue. However, we typically put the stock ticker symbol here, the growth rate per analyst estimates, and that current yield on AAA corporate bonds, and this would give us an intrinsic value. So now moving on to the first model that was applicable, we have the multiples valuation model. We have companies in a similar sector and size, Taiwan Semiconductor, Broadcom, Qualcomm. The stock price, earnings per share, P multiple, we get the average, multiply that by the earnings per share of Nvidia, and what we see here is a valuation price of $205. Now when we take a look at that, that is within that 52-week range, which isn't hard given the massive spectrum we see on either side, that huge spread. And it does show signs of overvaluation based on that model alone. Remember though, we're not looking at any of these models in isolation and purely drawing our conclusions at the end. So the dividend discount model, we have the yearly dividends over the last 4 years where we see no growth as we saw in our analysis of the metrics. Now forward looking, I've gone just to keep it consistent at 0%, but what this effectively does for the DDM price, it comes to a valuation of $2. Now, essentially, this model isn't appropriate as well, given that their yield is incredibly tiny. And regardless, even if we had increased this to a yield of, say, 5%, it wouldn't really do much for the DDM price, given how low that starting yield is. So we will remove this from our final intrinsic valuation. So now we move on to the discounted cash flow model, where we have our free cash flows year on year. Average growth rate at 30%. Now, forward looking, we have gone for roughly the same, and we will touch upon this very shortly on the video. Discount rate at 8%. Now this gives us the present value of future free cash flows and terminal value. Add the cash, subtract total debt, arrive at the equity value, divide by shares outstanding to give a DCF price of $197. Again, significantly below the current trading price, but within that 52-week range. Now, the intrinsic value, as always, is just the average of the models that we run through that are applicable. And don't forget, if you do enjoy the content, value is being provided, do hit that like button, subscribe and hit the bell so you're continually notified of these videos. Now, the intrinsic value, as always, is going to be the average of those two models that are applicable. Now, there's no real point in putting a margin of safety. As we can see, the intrinsic value is significantly lower than the effective current price. But if we were looking, for argument's sake, at a 10% margin of safety, you'd be looking to buy around $181. And we can see that is still within the 52-week range. For those looking at around 20%, at around $160, again, still within the 52-week range. Now, realistically, in my opinion, the best way to effectively value this company is on the DCF model. And what I want to show you is effectively it really comes down to what you believe the growth rate forward looking for this company will be on the free cash flow. So if you were to move this to around 40%, we can see the DCF price would be around $368. If we move it to around 45%, at around $497, which is roughly where the current price is, although a few dollars short. So you could argue that currently the price that it is being baked into the market is showing signs of a 45% increase year on year to the free cash flow. Now, some people will argue that that's not appropriate. Some people will argue that maybe it is. And when we come to look at Wall Street, well, they believe that the share price will hit around $648 over the next 12 months. So they do believe there to be some nice upside to the current trading market. Now, for the price to hit around $648, in terms of looking at what that growth rate expected would be, we can play around with the numbers. Even if we look at that 50%, 667, which is near around that Wall Street price. So they believe around or slightly lower than 50% increase to the free cash flow year on year for Nvidia, which is incredible if they do manage to hit that. So it is one thing just to bear in mind when you are investing in a company like Nvidia. It does come down to the future projections. Now, do let me know your thoughts in the comments below. Is Nvidia one you either hold, looking to buy, or even looking to sell? I'm generally interested in this company, which has increased significantly this year. It isn't one that I personally hold, and it also isn't one that I will be looking to add, as I do believe it right now to be fairly overvalued. even with the massive increase or with the positive news that they had that we saw from their earnings where they did do a significant beat, we can see the share price today is down around 3.5%. As always, let me know your thoughts in the comments below. If you've enjoyed today's episode, smash that like button, hit the subscribing bell so you are continually notified of these videos as they drop. Finally, if you do want to grab a copy of the intrinsic value calculator to get to the intrinsic value and acceptable buy price of companies in your own portfolio, or even if you just want to run through Nvidia again based on your own estimates, do click on that pinned comment. As always, have a great day, catch you on the next episode, and take care.